Do you believe that what you outlined this morning is going to silence the critics of AIG, and in particular, Carl Icahn?
What we laid out this morning is what we're going to do over the next 2 years to make this company more focused, more profitable, and return $25 billion to shareholders. That's speaking to all of our shareholders, all of our policyholders, all of our regulators, all of our stakeholders. I'm sure we won't satisfy all of them, but we need to deliver a sustainable franchise if we're going to make the right decisions of trading off long-term versus short-term urgency to deliver results.
Why not break up the company?
So AIG is a much more focused company than it was before the financial crisis, and we have focused it down to the essence of what can deliver value to our clients. And remember, our business is absorbing the risks of our clients and managing them. And to manage those risks, we need to use diversification. So diversification is critical, and if you were to break up the company, you would lose between $5 and $10 billion of diversification benefits at the minimum, and that's in the eyes of the rating agencies. And
is it the tax assets that you're talking about?
No, this is just simply risk diversification. It's saying that you have a sizable property casualty business which has uncertainties balanced by the stable cash flows of the life and retirement business. From a tax perspective, that's a further reason why splitting the company would be very expensive. We would lose approximately $1.3 billion per year in foreign tax credits if we split life and retirement from property casualty this year or next year or the year after. So it's an annual cost that we would incur. And if splitting them was to, for instance, influence our role as a SIFI, that cost to us is about 1/10 of that.
Right.
So the tax benefit is roughly 10 times the cost of being a SIFI. So that's certainly not a reason, but the diversification issue is a much greater issue.
But Peter, Carl Icahn and others would say that diversification hasn't worked. Your return on equity lags your peers. So how is this new design that you've unveiled this morning going to bring you back to double-digit returns on equity?
So what we have done is, in this disclosure, help people understand our return on equity by dividing it between our operating businesses and the legacy businesses. And more than a quarter of the company's capital is dedicated to legacy activities, things that have accumulated over decades that were in the business of exiting, either through sale or just gradual runoff.
Okay.
And that has an ROE that's between 3% and 5%. And so by breaking out the operating business, there the ROE is much more competitive, and we have plans to make it very competitive, so peer comparisons are more meaningful than looking at the aggregate numbers.
Okay, how is your hedge fund performing right now?
So the hedge funds are an important part of our portfolio that we are reducing. It's not an efficient use of our capital, so we'll be diminishing our allocation to hedge funds. But it's about $11 billion portfolio out of about a $400 billion balance sheet. So it's a modest allocation, but it has been disappointing over the last couple of years for sure. But we will stay in a more focused group of hedge funds as part of our strategy. But if you look at our plan to return $25 billion of capital to shareholders over the next 2 years, part of that plan is reducing our allocation to hedge funds. About $2 billion of that return to shareholders is by de-risking the asset side of our balance sheet.
And Peter, Icahn wants you to, as well as others, they want you to focus on your property and casual, which has not performed that well. How do you plan on creating profit in that unit in a time of lower rates? Rates are going lower, in fact.
So an important part of this plan is to break the property casualty and the life and retirement business into more modular business units, at least 9 to start off with and then more later. And what you'll see as we do that and reveal the return on equity at that level is some of them are performing exceptionally well. Others have work to do. So I think that demonstrating the pieces that need work and demonstrating a combination of cost initiatives as well as more narrow focus on the more profitable sectors, we'll deliver the margin improvement that's necessary over the next 2 years.
All right, Peter, thank you so much for joining us here at the New York Stock Exchange. Peter